Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
We really need to break down what just happened with Infosys stock. I mean, that sequence of price action between, December 16th and the 19th, it was just highly unusual. It wasn't just, typical volatility. It felt like it exposed a real fault line and how the market is valuing the entire sector.
It was a wild ride, no question.
Right? You have the stock dip pretty hard on the 16th, almost 1% down, just on those general macro fears. Then the 17th, it kind of stabilizes, which was strange because the rupee hit that historic low, 91.07 to the dollar. But the real shock was Thursday, December 18th. The stock it launched. It went from a small gain to, at one point, over 4% up intraday. So the fundamental question is, what is actually driving this? Is it a deep-seated fear about technological obsolescence, the kind of stuff you see retail traders talking about? Or is this just sophisticated institutions playing their games with market mechanics and capital deployment? I'm arguing that the retail fear, it's a real signal. It's a fundamental vulnerability that the institutions are trying to paper over.
I see that, and the narrative is definitely powerful. But when you actually look at the mechanics, the plumbing of the market, the picture looks completely different. That sharp recovery you mentioned on the 18th, that wasn't some sudden change of heart from Main Street. It was a textbook, almost mechanical reaction to three institutional catalysts that all hit at the same time. The fundamental fears you're talking about, the whole existential threat of AI, sure, they make for great forum posts, but they are consistently being overridden by the raw mechanics of global capital. I would argue the stock is acting less like a tech company and more like a highly efficient financial instrument. Its value is coming from its utility and arbitrage and liquidity, not from the perceived death of its old business model.
Okay, but let's define that vulnerability, because I don't think this is just retail chatter. It's a serious structural critique. My whole position is that the market is applying a completely justified legacy discount because the core time and materials business model is frankly obsolete.
Time and materials. Okay, for anyone listening who isn't deep in IT jargon, can you just quickly unpack what that means in practice?
Sure, yeah. When we talk T&M, we're talking about a model where Infosys bills its client based directly on the number of human hours worked. You're literally selling headcount. You buy 10 engineers for 100 hours. The entire margin, the whole business is built on billing high in dollars or euros and paying lower wages back in India. Generative AI it shatters that equation. And AI doesn't bill by the hour, it bills for the result. And if you can automate, say, 60% of what a junior developer used to do, well, that revenue stream just evaporates.
And that's where you get those, let's call them crude narratives you mentioned. The boomer tech or body shop labels.
Exactly. They're crude, I agree. But they get to the heart of that structural threat. And we've seen people putting their money where their mouth is. I mean, active traders are explicitly buying put options, bearish bets, timed for 2025, and their logic is pretty sound. You combine radical AI labor replacement with potentially new H-1B visa restrictions in the US, and you have a perfect storm that could just slam, to use their word, the entire industry by destroying that human labor arbitrage. This isn't just noise. It's a real directional bet on a structural failure.
I'm not denying the AI threat is real. Of course, margin compression is a risk. But if that vulnerability were truly the dominant force right now, we would have seen the stock collapse, not stabilize and then surge. I'm sorry, I just don't buy that the fundamental story is in the driver's seat. Not yet. My view is that the stock's role as a high-volume liquid financial tool is what's setting the price floor, and it's being propped up by very aggressive corporate and macro factors.
Okay, then give me the evidence. Show me how those structural factors are so powerful they can just brush off this fear of fundamental obsolescence.
The proof is in the December 18th rally. It was a convergence of three things, all institutional. First, the rupee hitting 91.07. For big money, Infosys is a classic defensive rupee hedge. They earn almost all their revenue in hard currencies like the US dollar, but their biggest cost, their huge salary base, is paid in a weakening Indian rupee. So as the rupee falls, their margins just automatically expand. It's immediate, it's quantifiable. Second, and this was the big one, Accenture's Q1 earnings came out that exact same day. Accenture is the bellwether for the whole sector, and they reported this massive surge in new bookings. We're talking $20.9 billion. That wasn't just good news, it was validation. It showed that big companies are throwing money at AI implementation. It completely shot down the whole dinosaur critique. These old firms aren't dying. They're the ones being hired to manage the entire AI transition. So the argument is that the demand for AI consulting is actually bigger than the destruction of the legacy work, for now at least?
For now, exactly. It validates that the cash is flowing. And the third piece, the active 18,000 crore rupee share buyback program. That program created a hard, non-negotiable floor for the stock price, right around that 1550 to 1600 rupee level. These are hard mechanics absorbing selling pressure. This isn't about vague feelings or sentiment.
Let's unpack those mechanics then. Let's start with a huge short interest in the stock. To me, that screams skepticism. See, this is where we have to challenge that simple assumption that short volume equals bearishness. The technical nuance of a cross-border listing is key here. The data is absolutely clear. INFY consistently has an off-exchange short volume ratio in the ridiculously high range of 40 to 65%. The FinRed data for that week specifically had it at 64.96% of daily volume happening off-exchange.
That is an enormous number. Nearly 2/3 of all trading is happening in private.
It is. But that volume is overwhelmingly structural arbitrage, not people betting the company will fail. For anyone not familiar with how this works, Infosys trades in two main places: on the National Stock Exchange of India, the NSE, as a regular share, and in the US as an ADR, an American Depository Receipt, which is basically a certificate that represents a bundle of those underlying Indian shares.
And what happens when the prices of those two things get out of sync?
That's the trade. When the US-listed ADR trades at even a tiny premium to the actual share price in India, once you adjust for the currency rate, an institution can make a very low-risk profit. They short the more expensive ADR in a dark pool, a private exchange where a huge trade won't move the public price. And at the exact same time, they cover that short by buying the cheaper underlying shares in India. They pocket the spread. It's a high-volume, low-risk, mechanical trade. And it's a feature of the whole sector. Wipro's ratio is even higher, over 70%. It's just financial engineering. It is not a vote of no confidence.
Okay, I see your point. I'll concede that the arbitrage mechanism explains the speed and the location of the shorting, why it's happening in dark pools. But I'm not convinced it completely dismisses the directional risk. We are still talking about an absolute short interest of, 150.6 million shares? And more importantly, a very high days to cover metric. It's clocking in at 17.32 days.
And why is that specific number, 17.32, so important to you?
Because days to cover tells you how long it would take for all the short sellers to buy back their shares based on average daily volume. A high number like that suggests that unwinding those shorts, even if they were for arbitrage, would cause chaos if any bad news forced them all to run for the exit at once. The retail fear, which I think is tapping into something real, is that once these structural props, like the weak rupee or the arbitrage window, disappear, that massive short position becomes a huge vulnerability. It represents skepticism that's just waiting for a reason to break that floor you talked about.
But I think you're misunderstanding how the covering actually happens. It's not the frantic open market buying you see in a classic short squeeze. It's a systematic conversion of the Indian shares back into ADRs. It's an external financial process. That high days to cover number's more a function of the pipeline, the mechanics of ADR conversion, than it is a sign of a bunch of trapped bears. It's really a definitional quirk of this specific cross-listed structure.
That is a very technical and fascinating distinction, but okay, even if the shorts aren't trapped, let's talk about the second major structural prop, that massive buyback program designed to keep the price up.
Yes, let's talk about their capital allocation.
I would frame that buyback as a sign of anxiety. I mean, the sheer necessity of an 18,000 crore rupee buyback at a 19% premium, no less, up to 1,800 rupees a share, That suggests management is fighting to defend a valuation that the market just doesn't believe in. To me, that's a sign of weakness. They're using their balance sheet to create a temporary floor to hide these deeper issues around margin compression from AI. Why spend billions on your own shares when you could be acquiring cutting-edge AI startups?
That's a brutal take, but it completely ignores the history here. I totally disagree that this is desperation. This buyback is a confident, deliberate strategy, and it's completely consistent with the company's long-term history as a growth and income compounder. I mean, if you look back, they have a verified history of expanding equity through forward splits and bonus issues. They never did a reverse split, which is the real sign of desperation. 100 shares bought before the year 2000 would be 12,800 shares today. This buyback is just the latest version of that policy.
But that premium is still huge. You only pay a 19% premium when you think the market has it completely wrong and you desperately need to close that valuation gap.
It signals confidence. But here's the real clincher: promoter confidence. The founders, the people who built the company, they chose not to sell their shares into the buyback. By holding on, they're signaling they believe the real value is way above 1,800 rupees. And by not participating, they actually increased the acceptance ratio for the small retail investors. It was a perfectly executed move to stabilize the retail base while sending a powerful signal to institutions that the balance sheet is rock solid.
A signal that needs macro forces, like a weak rupee to justify its cost. Which brings us right back to our third point, what really drove that price action in December. I mean, if the fundamentals were so strong, they wouldn't need a currency tailwind to pad their margins.
That volatility event was overwhelmingly derivative of those macro and sector factors. The fear on December 16th was from generic trade war talk and the rupee hitting that 91.07 level. But the recovery on the 18th was triggered by two clean institutional-grade inputs:
The RBI intervention and the Accenture earnings.
Exactly. The RBI stepped in, the rupee pulled back a bit to around 90.38, which eased the pressure. But the real driver was the Accenture report hitting at the same time. Let's focus on that 20.9 billion in new bookings. That number isn't just big, it's a categorical refutation of the fundamental collapse story. It told every major fund manager that demand for complex digital transformation, including AI implementation, is accelerating, not slowing down. It instantly validated the health of the whole sector and let INFY decouple from the rest of the Nifty 50, which was struggling that week.
I'll concede the immediate impact of the Accenture print. That clearly turned the tide in the short term. But I have to come back to the structural problem. Why should an advanced technology company be so reliant on a weak home currency to make its numbers look good? The very fact that the stock works as a currency hedge just highlights its vulnerability when things stabilize. The core issue, shifting contracts from billing for people to billing for AI, that pain is still coming, no matter how many new bookings they announce.
The institutional view is pragmatic. They see a company that gushes cash flow and a management team willing to use that cash to defend the valuation. While retail is focused on the theoretical threat to the TNTM model, institutions are focused on the verifiable cash being generated right now and the clear demand for AI services that Infosys is capturing. The market is valuing the stability and the mechanics, not the disruption narrative.
And I think that tension, that gap between the narrative of disruption and the financial mechanics of stability, that defines this stock right now. I acknowledge the power of the arbitrage and the buyback floor, but I have to maintain that these are temporary safety nets stretched over fundamental quicksand. The long-term risk from the T&M model becoming obsolete, that remains the most important factor. And eventually, the market has to bake that reality into the price.
And I'd argue the opposite. The observed market action, especially that huge dark pool volume and the sharp, catalyst-driven rally on the 18th, it just proves that the institutional mechanics are what's in control right now. INFY is operating as a defensive compounder and a complex arbitrage vehicle. That's the reality on the ground, and it's a reality the retail disruption story has so far failed to dent in any meaningful way. For now, capital and currency are king.
Well, the ultimate test of this whole structural versus fundamental battle is going to come pretty soon with the Q3 earnings release.
Absolutely. That release, scheduled for January 16th, is going to be crucial.
We'll finally see if all this AI revenue they're talking about is truly new, additive growth, or if it's just cannibalizing their traditional business. That's the data point that could either validate the fears of the bears or maybe, finally, silence them.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.